What you got, everybody? Oh my goodness, welcome aboard. What is today? Today is our day to bond over bonds. That's right. Long history of bonds on the exam. I mean, it goes back far. So I remember back in the day, lots of questions on bonds. So you are going to become a resident expert in bonds today. So anything and everything you ever wanted to know, discount, premium, trading at par, zero coupon bond sold between interest dates. We got to accrue for the interest and give it to the seller, then give it back to the buyer. Bond costs, oh my goodness, make that premium smaller, discount bigger. Let's go. All right, so bonds payable is our topic today. Who are we? We are the absolute leader in education technology. You want to be a doctor, you want to be a pharmacist, you want to be a lawyer, you want to be a CFA charter holder, a CPA, CMA, you're in the right spot. So we absolutely kill it. The software, the artificial intelligence, the instruction, soup to nuts, man, customer service, you name it, we got it. But really, it's an amazing team, but we want you to see it and try it before you buy it. It's obviously the reason we do these free events, because we think you owe it to yourself to do a test drive before you pick the partner that's going to get you through the exam. And our goal is obviously not just to get you through the exam, but we really like to do so in the first attempt. So we'll talk to you a little bit about that strategy. I am joined today by my colleague, Charlotte Roberts. She's a BP. Hell no, not me. And Megan Burke, a PhD. Let's go. So ladies, once again, just say hello real quick.
Hello, everybody. Welcome. Look forward to sharing a little more information about UWorld, and as Peter mentioned, how we're going to get you to pass the CPA exam here later on today.
Yeah, hi, welcome on this, for most of us, really cold day. I'm just excited. We got Pete here to keep us motivated, dancing around to keep us warm, right? I'm excited to hear about bonds, so I can't wait.
So any questions you have along the way, all kidding aside, Megan Burke is probably the most popular instructor, never mind at UWorld, but in not just CPA review, just education in general. So she's going to be your point person behind the scenes. She is the wizard. I'm just the, I don't know what, I'm like Toto. She's the wizard. So she's behind the scenes. Any questions you have, you type them in and she'll be very happy to help you out.
I have all the answers.
She has, they gave you the answers, man. They never give me the answers. Damn.
I have all the answers.
See, they make me try to figure it out from scratch, but that's all right. So Megan will be behind the scenes answering your questions. So you type them in along the way. So I believe we have that function going. So we obviously will not be covering privately placed notes today, just the bonds payable, but just, you know, in the UWorld course, this is part of obviously that same chapter, whether it be a note or a bond, it's negotiated debt. It's interest-bearing debt. And that's what separates a financing liability from an operating liability on the statement of cash flow. So I'll remind you, our goal is to connect the dots, folks, because there's a lot of things, a lot of topics that appear in multiple places for a variety of reasons. Obviously, we have notes payable or bonds payable, individualized topic. But then, as I mentioned, that could be a part of a statement of cash flow question as well. And it's not just when you issue the bond. What if you buy the bond? And that's going to be a cash outflow investing. Maybe, if it's fair value through OCI or held to maturity. But if they buy it to trade it, then it could be a current asset. All right. And then in that case, it would be an operating asset. All right. Nonetheless, you know, we're gonna walk you through as though you haven't seen it before. So bear with us. What we do in our course, we always show you the representative task, folks. It's very important. You know exactly what it is the AICPA expects from you exam day. So is it, you know, a math intensive question? Obviously it is. So part of it is calculating. Anytime you start getting into understanding, analyzing, applying, then obviously they can break this up, and it makes for a good task-based simulation, which bond does oftentimes. So before we get started, what I wanted to do is just right up front, I think it's very important. The more senses you engage when you study CPA exam content, the more likely it is you're going to remember it. So watching or reading is nice, but I always tell people, if you hired me to be your trainer at the gym, watching me on the treadmill is not going to do much for your cardiovascular health. So get your pen and paper. You're getting on the treadmill with me, because what you write, you will remember. And then if you're on a date tonight, explain to them everything you've learned here today. And then you could see, is that person really your soulmate? Because if they're there at the end of that date, either they got serious psychological issues, in which case you should run now, or they really love you. One or the other, I don't know. Probably the first, though. All right, so if you take the carrying value of a liability at the beginning of a period, okay, whatever the carrying value, the book value of that liability is at the beginning of the period, you multiply it by the market rate, not the current market rate, folks, the yield to maturity when that security was issued, okay, the market rate when it was issued. This is how we calculate interest expense that you will see on the income statement. I don't care if a coupon's paid or not, because we're not cash basis, we're accrual basis. If you want the coupon that's paid, take your par value, also known as your face value, multiply that by your coupon rate, and there's your coupon paid. If there's a difference between the interest expense and the coupon paid, that is the amortization. You gotta love that word. What does that word mean in English? This is what we're gonna record. When bonds are issued at a discount, that's a loss. But we can't call it a loss because then people will know what we're talking about. So instead, we'll call it a discount, and we will record that discount, amortize that discount over the life of the bond by looking at the difference between the interest expense and the coupon paid. That differential will cause the carrying value of that liability to be pulled up towards par, as you're going to see. If we ever issue a bond at a premium, well, that's code language for a gain. That means we sold it for more than the face value. Well, that good news, that gain is recorded, amortized over the life of the bond by making interest expense less than the coupon paid. As we amortize that premium, the carrying value of that liability be pulled down towards par. So from here on in, when you see disco, you think that's where the happy people go. When you see discount, you think loss. We record that by making our interest expense greater than our coupon paid. We spread it out over the life of the bond. How do we know we sold it at a discount? The selling price is less than that par value, that face value. Little by little, as we record that loss, what's going to happen to the carrying value of that liability? Pulled up towards par. If we sell it at a premium, you're going to be thinking, hey, that bond was sold at a gain. That means my interest expense, the way I'm going to implicitly record that gain is by reducing my interest expense such that it's less than the coupon paid. And little by little, by reducing interest expense, that's how I'll get that gain on the income statement, but over the life of the bond, rather than initially when we record the bond, which violates the matching principle. How do you know you sold it at a premium? Selling price is more than the par value. Little by little, as we record that gain, carrying value of that liability pulled down towards par. So this is the name of the game. You watch it, you read it, you write it, you speak it. It's repetition. Nothing here is rocket science, all right? It reminds me of my first job working in a grocery store. They said, Pete, you got to stock this can of tuna. And there were like 30 aisles and all these different products. I was like, damn, where does the tuna go? Well, after a few weeks of stocking the tuna, I eventually knew where the tuna went. This is just like stocking tuna, okay? This is not rocket science. Far from it. All right. Now, you're going to have one side who's the bond issuer. Folks, the party that issues the bond, the party that issues the bond, okay, they're the borrower. The party that buys the bond, and let's just do this. Issuer is synonymous with borrower. Okay, they're going to receive the cash. They're raising capital. So from the perspective of the issuer, they'll debit that cash, and assuming no discount or premium, they'll credit that bond payable. On the flip side, you have the investor. You have the lender. They're going to pay that cash. So it's the flip side of the same coin. It's a zero-sum game. One side's cash in is going to be the other side's cash out. So the investor, they'll have an investment in bonds, and then they will obviously credit cash. Now, in a separate lecture, although I would remind you during the course, when you invest in bonds, there's different ways to record that investment. As I mentioned, it could be held for trading. It could be fair value through OCI, or it could be amortized cost, held to maturity. But that's a separate lecture, but it's important you understand you have two sides, the issuer, the investor. Okay, whoever the issuer is going to have interest expense. They'll either be crediting cash or interest payable. Let's say the bond is issued at par. On the flip side, you're going to have the party that's receiving that interest. One side's interest expense will be the other side's interest income. Okay, so again, it's a zero sum game. So you should be able to do the journal entries from either side of the coin. The big issue for us, though, is when you invest in a bond, how do we account for an investment in a bond? That would be an asset. Okay, so again, held for trading. Is it possibly going to be fair value through OCI, available for sale? Is it going to be held to maturity, also known as amortized cost? But this is where I was saying earlier that a lot of the concepts appear in multiple sections of the exam, okay, due to that overlap. Definitions you got to know, easy theory, get it right right away. If it's a term bond, all maturity, all principal gets repaid at maturity. Okay, that's primarily what we'll be dealing with. Notes don't necessarily work that way. Bonds oftentimes do. It is possible that it's a serial bond, not like a serial killer or anything like that, just a serial bond. We'll be paying off the principal in stated amounts over time. Sometimes that reduces the risk of financial distress for the borrower, because rather than having to pay all that principal at once, they pay it off little by little over time. Sometimes the debt is secured, sometimes it's unsecured. If it's a debenture, that means the only thing securing that is the company's quote unquote general credit. All right, you're an unsecured creditor, but sometimes the debt is collateralized. Anytime you see secured, you think, hey, there's some type of asset that's been set aside. In the event of a default, we have the right to seize this asset. Maybe it's the company's receivables. Maybe it's their inventory. Maybe it's their PP&E. Okay, bonds get registered, specific owner, or if it's a bearer bond, then it's not registered, who's ever in possession. Okay, derivatives. Sometimes the bond is callable. That gives the issuer the right to refinance. If interest rates go in what direction? Down. I borrowed when rates were high, I want to refinance at today's lower rates. Okay, they have the option to call it, that's what they would do. Convertible bonds, now that is held by the investor, okay, the option buyer, that's held by the investor. It gives them the right to say, you know what, for right now, I'm going to buy your debt, but it's convertible into equity. In the event that stock price goes up and that option goes in the money, whatever the carrying value of that liability is, that's going to go down for the issuer of that convertible debt. And instead, their equity is going to go up. There's no change to assets, okay? If the debt converts into equity, that's at the option of the issuer, but excuse me, the investor, but that's if and only if the stock price goes up. Okay, we're always worried about the borrower, the issuer, having enough money to repay that debt at maturity. So sometimes what we require is, hey, a sinking fund. Basically, we want you setting money aside to pay off this debt little by little over time. So they buy back, pay off some of that principal periodically. That reduces the risk that at maturity, they won't have all the money necessary to pay off all the principal at one time, okay? So just terminology. We're gonna get it right, and we're gonna get it right quickly. Okay, interest payment dates. Is it annual or semi-annual? When you read a bond question, you're immediately looking for that. That's gonna affect the term. Okay, I'm looking for my stated rate, my coupon rate. That's obviously going to dictate the cash payment. The coupon payment, which is an annuity, multiple payments of the same amount. Alrighty. So those payments for coupons, when it's a bond, are going to come at the end of every year or every 6-month period. So we're going to be looking for the present value factor of an ordinary annuity. Tell me the number of payments we're going to be making, not the number of years, the number of payments, which is dependent upon annual or semi-annual, and tell me what the yield to maturity is, the market rate is. And if it's semi-annual, we may have to divide it by 2, okay, depending upon the facts. At some point in time, that maturity has to be paid. We're going to need the present value factor for a payment of one-time payment at the end of the bond's life, at maturity. Again, I need the number of periods, and I need the yield to maturity, the market rate. Folks, the market rate dictates the price of the bond, not the coupon rate. All right, so whenever we look up our present value factors, we're looking for market rate, sometimes called yield to maturity. Okay, I need to know the issuance date, I need to know the maturity date. Term, number of years or If it's semi-annual, we're going to take the number of years to maturity and multiply it by 2. Okay, so I always need to know, again, annual or semi-annual. And then your yield, your market or effective rate. This dictates present value factors, the selling price, and the interest expense. Okay, that is all dictated by the market rate, sometimes called the yield to maturity, the effective rate. What's relevant is the market rate at issuance, not current market rates 3 months later, 6 months later. All right, what we're only concerned about is, hey, what was that rate when we borrowed the money? Okay, bonds payable, financing. It's a way to finance, so from the perspective of the issuer, the borrower, it's a way for them to finance their operations, okay? When they issue the bond, they've got a financing inflow. When they repay the principal, that will be a financing outflow. Now, some of that money might be due within the next year. Even though it eventually becomes a current liability, it's still a financing liability. It's just that, hey, 30 years ago was long term. Well, 29 and a half years later, it's now a current liability. So any principal due within the next year will be listed as a current liability, but it's still a financing liability. Anything that's due beyond this year, well, that's a non-current liability. Okay, you don't need any timelines, but look, what I need you to do is find me the present value of the interest payments. So step 1, take the face value times the coupon rate, and let's say it's semi-annual pay. All right, let's pretend it's semi-annual. Take the face amount times the coupon rate times a half. There's your payment. I need you to find for me the present value of those payments. I need the present value factor of an ordinary annuity. The present value factor of the ordinary annuity, tell me the number of periods, and if it's semi-annual, that will be the term times 2. Then you will take your yield to maturity, divide it by 2, and that's how you will find the right present value factor of an ordinary annuity. For the principal, that's the present value of a one-time future payment. Again, you need your number of periods times 2, yield to maturity divided by 2. Present value factor of a one-time future payment. Okay, so we're going to take those future coupon payments, find the present value. We'll find the present value of the principal, and here's your bond proceeds. There is your selling price. If the selling price equals the face, the bond was sold at par. If the selling price is less than the face, we got a disco where the happy people go. If the selling price is greater than the face, then we have a premium. How do you know it's going to be par? How do you know? If the coupon rate equals your yield to maturity, you know that bond will be issued at par. How do you know it's going to be a discount? If the yield to maturity is greater than the coupon rate, the price is going to be discounted. Okay? How do you know the bond is going to be issued at a premium? If the yield to maturity is less than the coupon rate, then you will collect more than face value. That's a P in the denominator. Sorry, guys. That's a P in the denominator. Okay? So with the principal, what are we looking for? Present value of a one-time payment. Okay? An annuity due does not apply to bonds. It might apply if it's a note. It might apply if it's a lease. Okay? But generally with bonds, the payments do not become at the beginning of each period. An annuity due means the first payment happens immediately, happens now, at the beginning of the year. Okay, that's rare with bonds. What we're going to see with bonds, ordinary annuity. Okay, payments happen at the end of the 6-month period or at the end of the year. What always dictates our present value factors? Present value factors and selling price are dictated by what? The market rate. What's a synonym for market rate? The yield to maturity. What's a synonym for that? The effective rate. Okay, so different terminology you might see. Interest rate on the bond. If it's due semi-annually, what do we got to do? Take the term. Well, it's right there. Take the years multiplied by 2. That gets you your total number of periods. And take the annual rate divided by 2. That's what we call the periodic, also known as the semi-annual rate. And this will dictate your present value factors. Okay, that's going to dictate your present value factors. And when we look up our present value factors, it's always dictated by what? The market rate for that number of periods at that market rate. Okay, at that periodic rate. Interest expense. Accrual basis, folks. I don't care if we pay the coupon or not. Okay, record in period incurred, not when or if coupon paid. That's irrelevant. Even if it's a 0 coupon bond, we're still recording the interest over that life of that bond. Why are we doing that each period? Matching. We are not cash basis. We are accrual basis. As a general rule, folks, unless they tell you otherwise, we'll be recording interest expense using the effective interest method. The bonds payable outstanding balance at the beginning of the period times the market rate, not the current. The market rate at issuance, folks. What the current market rate is, distractor, cross it out. I need the market rate at issuance. And then multiply that by, watch your dates. If it's issued, let's say on January 1, then you will be recording 12 months worth of interest. If it's issued February 1, you'll be recording 11 months worth of interest. If it's issued November 1, then you'll be recording 2 months worth of interest. 12 over 12, 11 over 12, 2 over 12. Watch those dates. Just like with depreciation, it's so predictable. They love to mess with the dates. If they're going to do straight line depreciation, they'll be insulting you. The only way to make that remotely interesting is that the property wasn't bought January 1. It was bought, I don't know, sometime in March or something. Okay. So we're going to go through this step by step with examples. Ready? Bond is issued at par. How do we know it was issued at par? Your selling price equals your face value. And what's synonymous with face value? Par value. It's all the same. Your coupon rate equals your market rate at the date of issuance. That means your interest expense equals your coupon paid. There's no disco to go to. There's no loss. There's no gain. Easy as could be. Okay? So, always set it up this way. They tell you your coupon rate is 6. Then you tell you your yield to maturity is also 6. 6 principal. My market rate is also 6. This is my coupon rate. That means I'll sell it at par. I'll sell it at par value. Okay? So if your coupon and your market rate are one and the same, you're going to sell it at par. All right, let's do an example. Here we go. This is where oh, shit. Be the second time I knock down my cup of coffee, damn it. All right, here we go. You ready? Legalized cheating. Don't start up here. I don't know what to do with all these facts. Start here. What are the journal entries we're going to record? January 1 and June 30, year 1. All right, what's going on in this question? January 1, we issued. That means we're who? We're the borrower. Okay, this is a financing inflow. A 10%, that's my coupon. $1 million bond due in 4 years and is equal to 4 as of right now. Interest on the note is due how? Semi-annually. Stop right there. Take that coupon rate, 10 divided by 2. My payment is going to be 5. Take my term, 4 years, but 2 payments per year, that's 8. That's really the number of payments. We're going to be making 8 payments. Okay? They tell me the yield, the market rate, is also 10. Coupon 10, market rate 10. It's going to be sold at par value. Easy. So you do not need present value factors. That's a waste of your valuable time. Exam day, don't need it, because your selling price is going to be equal to the face value, which is how much? 1 million. So that means we are thinking big picture. I'm going to have a financing inflow, 1 million. Someday at maturity, I will have a financing outflow. But as of right now, it's $1 million payable. That $1 million times 10% divided by 2, I'm going to have $50,000, which is going to be both my coupon paid and my interest expense every 6 months, okay, for the next 4 years. All principal paid at maturity. That's it. You don't need to worry about any present value factors. So you can save lots of time if it's issued at face value. Got it? Now, just as an FYI though, present value factor of an ordinary annuity times your coupon payment, that gets you the present value of your payments. Present value factor of a one-time payment, present value of a one-time payment, that is for your principal. Present value factor for my coupon payments. How many payments do we have? 4 times 2, 8. 10% divided by 2, 5%. And remember, that is both your coupon as well as your yield to maturity. Present value factors are always based upon what? Yield to maturity, your market rate. So this gets me the present value of my payments. Okay, the sum of the two is going to be $1 million, so we don't need to waste our time unless they ask for subtotals. Okay, so if they ask for subtotals, like what's the present value of that $1 million in principal? Okay, then you'd actually have to do the math. Or if they want the present value of the coupon payments, the $1 million times the 10% coupon divided by 2, 50,000. Present value of the principal, present value of the coupon payments, sum of the two equals your selling price. But we know that's going to be face value. Why? Because the bond is being issued at par. Okay, present value factors are always based upon what? The market rate dictates the selling price. Okay, so if they ask for those subtotals, here's the present value of my principal, present value of a one-time payment, present value factor, my coupon payments, that's the present value factor of an ordinary annuity, n equal to 4 times 2, 8 payments, yield to maturity, 10 divided by 2, 5%. Okay, so you would find those present value factors. You have the present value principal, present value of the coupon, sum of the two, that is your selling price, which we anticipated bond would be sold at par. So your journal entry, you debit to cash, that is a financing outflow. That makes your assets go up. You obviously credit bonds payable. Long-term liabilities go up. Bonds payable is long-term until end of year 3. Bond is due when? In 4 years. Then once that principal payment is due within a year, then that bond payable goes from long-term to short-term, but it is still a financing liability. Okay, coupon payments and interest expense. Carrying value, when a bond is issued at par, bond issued at par, the carrying value does not change. Okay, your coupon and your market rate are one and the same. 10 divided by 2, 5. My interest expense is going to be the same as the coupon paid. There's no amortization of any discount or premium. Okay, so your interest expense and your cash payment are one and the same. How many payments are we going to be making? A 4-year term, semi-annual pay, we will be making 8 payments. Okay, carrying value of the liability is constant, will never change. Okay, whenever a bond is issued at par, interest expense equals cash payment. There's nothing to amortize. This is not exciting. Okay, carrying value does not change when issued at par, but if it was issued at a discount, carrying value of liability will be pulled up toward par if it were issued at a discount. If it's issued at a premium, carrying value of that liability is going to be pulled down toward par over time. The only time the carrying value of the liability stays the same is when the bond is issued at par. Every 6 months, same journal entry, every 6 months for 4 years. We'll be debiting our interest expense, cash outflow. Now, if any of my students on this call are international, under US GAAP, payment of interest, the payment, okay, this is always going to be cash outflow operating. I'm just going to move it down here. The cash payment, that is cash outflow operating. So for my international students, forget about IFRS. There are no options. It's always operating outflow under US GAAP. So this makes your assets go down. Interest expense will make our net income go down, which will make our retained earnings go down. Balance sheet is in balance. Assets down, equity down. Okay, so for my international students, always operating outflow. Okay, same exact entry every 6 months for the next 4 years. Okay, total of 8 payments. Bond term, when we repay the principal, folks, when you repay principal, that is financing outflow. When you pay interest, operating outflow. No options under US GAAP. Okay, US GAAP is very rigid. Sweet. All right, now the boring stuff is done. Now let's talk about a discount or a premium. A disco. You issued at a discount, that's a loss. Why don't we call it a loss? Because that would violate the matching principle. We've got to record that loss over the life of the bond by making the interest expense greater than the coupon paid. We know it's a loss because my market rate is greater than my coupon rate. I can't change the coupon. The coupon is fixed, so the proceeds on sale will be lower. So your selling price is less than the face value. You have a loss. Interest expense each period will be greater than the coupon paid. That's how we implicitly record that loss little by little over the life of the bond, by making your interest expense greater than the coupon paid. If a bond is issued at a premium, that's a gain. How do we know it's a premium? You get more in that denominator, meaning your market rate is less than your coupon rate. Your selling price is greater than that face value. Oh, good, gain. Can't book it as a gain because that would violate the matching principle. So instead, we will amortize, record that gain little by little over the life of the bond by making the interest expense a little bit lower than the coupon paid. Okay, we'll generally be using what's called the effective interest method. All right, you ready? If the stated rate is greater than the market rate, I don't know about you guys, the words always screw me up. I don't like that shit. Ready? Stated rate, also known as the coupon rate. Let's put in numbers. Let's say the coupon is 8%. Okay, but the market is only asking for, let's say, 7%. Okay, let's see. The market wants 7 less than the coupon. That means the bond will be, oh, very easy. Oh yeah, bond will be sold at a premium. Okay, that means we have a gain. My selling price will be greater than the par value. Okay, what if, again, my stated interest rate, I've got a coupon of 8%, but the market says, nah, we want 11%. Coupon divided by price. They want a number bigger than 8. That means that denominator is going to be discounted. You got a loss. Your selling price. Do not memorize. Do not memorize. Reason your way through it. Okay? You reason your way through it, you'll get it right every single time. Once you start trying to be lazy and memorizing stuff, that's the first thing you forget when you get a little bit nervous. All right. What's your journal entry? We're going to record January 1. What happens on January 1, year 1? We issued. That means I'm the borrower. Okay? I'm the corporation. Financing inflow. 10%, $1 million bond due in 4 years. Interest is due how often? Semi-annually. The yield, oh, stop right there. Now I can figure this out. Coupon divided by price, my yield. Your actual yield is dictated by the selling price of the bond. Okay, so we offered the world 10. The market said, nah, we want 12, something bigger than that. You ain't getting face value. Immediately, I'm thinking disco, loss, interest expense greater than the coupon, because the interest is dictated by the yield and the coupon is dictated by the stated rate. Ah, I see. Now, present value factors. Bond is being paid how often? Semi-annually. 4-year term times 2, 8. Coupon payment, 1 million times 10%, but twice a year, $50,000 payment. 12 divided by 2, my periodic market rate is 6%. So my present value factors are going to be dictated by the term, 8 payments, and the periodic rate of 6. So my present value factors, it's got to be 8 payments, 6 periodic rate. Okay. So principal, present value of 1, a one-time payment. So we'll have to find 6%, 8 periods. Oh, there's the factor. Multiply that by the face value, $1 million. What's the present value? 627,412. My coupon payments, an annuity. What's the definition of an annuity? Multiple equal payments of the same amount. Those are my coupon payments, $50,000 each. 6%, 8 periods. Oh, the present value factor is 6.2. Multiply that by 50,000. What's the present value of my coupon payments? 310, 490. Added together, what is the sum? Here is your selling price, your proceeds on sale. I'm predicting less than $1 million. 937, 902. If you didn't get something less than $1 million, you know you screwed up. Big picture now, folks. We just got cash. Financing inflow, 937, 902. We got to repay $1 million, but your initial carrying value, get ready, your initial carrying value has got to equal the selling price, your proceeds. So that means 1 million minus the proceeds, 937, 902, as I write 920. Therein lies my disco, 62,098. What is that 62,098? That is a loss. It is currently unrecorded. Why don't we call it an unrecorded loss? Because then people will know what we're talking about. So we have our own language. We're going to call it an unamortized, unrecorded discount. It's an unrecorded loss. How are we going to record that loss? Little by little over the life of the bond. What do I mean little by little over the life of the bond? The periodic interest expense will be based upon a rate of 6% greater than the periodic coupon payment of 5%. That differential is how we will record that loss little by little over the life. This is how we will record, amortize that loss, amortize that discount. Little by little, the carrying value of that liability is going to go up. Now watch this carefully. Ready? As the unrecorded loss goes down, think about this. As the unrecorded loss goes down, as you amortize it, as you record it, as that shrinks, what's happening to the carrying value of your liability? Little by little, it's being pulled up toward what amount? 1 million. So you don't have to memorize, folks. You know that the recording of the loss each period, the difference between the interest expense and the coupon paid, has to be added to the beginning carrying value, because that number's got to go up. It's got to go up. Okay. So again, present value factors are always based on what? The market rate at issuance, also known as what? Your yield to maturity. The market rate dictates the selling price and your present value factors. Okay, we knew coupon 10, market wants 12. You're not going to get the selling price of $1 million. You're going to get less than that. Present value of the principal, which is the present value of a one-time payment, plus the present value of your annuity, multiple payments. Present value of an ordinary annuity, sum of the two, selling price, less than face value as we predicted. That is a discount. That is a loss that we will record little by little over the life of the bond. Sweet. All right. Now remember, your interest expense and your coupon have to be recorded periodically. Interest expense and coupon paid every 6 months. So the interest expense is based upon the 12 divided by 2, the 6%, which is greater than the coupon 10% divided by 2, 5%. But we got to use the periodic rate. Notice something. My coupon payment will never change. That is the face times the 10%, 1 million, times the 10%, times a half, 50,000. That will not change. But what is going to change, I take the beginning carrying value of my liability. There's my beginning carrying value, 937,902. I'm going to multiply that by the market rate, 6%. What's my interest expense? 56,274. Yet my coupon paid is only what? 50,000. So what is that extra 6,274 of expense? That is a little piece of that loss that gets recorded that period. And what's that going to do to the carrying value of the liability? It will no longer be 937,902. After we record our first period of interest, that 6,274 will make the carrying value of that liability go in what direction? Up. Because we just recorded a little piece of a loss. As the unrecorded loss goes down, as you're subtracting a smaller and smaller amount, the carrying value of the liability is going up. Okay. So, ready? 62,000 is a loss, but we call it a discount that will be recorded over the bond's life. How? By making the interest expense at 6% greater than the coupon rate, which is only 5%. Little by little over the life of that bond, we will spread out that loss and record it, amortize it. So on January 1, year 1, financing inflow, asset up. Discount on bonds payable from the perspective of the issuer, the borrower. You ready? This has a debit balance. It makes the carrying value of the liability go down. This is the unrecorded amount, Okay, so that makes your liability go down. Bonds payable, that makes your liability go up. What is the net increase to our liabilities? 937,902. Same thing as what? Selling price of the bond. From the perspective of the bond holder, the investor, the supplier of the capital, flip side, they've got an investment in bonds. Assets up, 1 million. They've got a discount on that bond. They bought it at a discount. Now this is going to make their asset go down in value. Their net asset has to be the same thing as the issuer's net liability, 937,902. Okay, 62,098. How much did they pay for the bond? They didn't pay $1 million. They paid 937,902. Now that is probably an investing outflow unless it's listed as a trading security. Okay. So they have an investment in bonds, $1 million, makes their asset go up. Cash is going down by 937,902. Okay, 937,902. The difference from the perspective of the investor, That discount reduces the carrying value of their asset. Their net asset is $937,902. So non-current assets are going up probably, okay? Current assets are going in what direction? And I should say investing outflow, $937,902. Current asset cash going down. So folks, from the perspective of the bondholder, no change to liability, no change to equity, not even a change to assets in total, only a change in form. They're less liquid. Cash went down, $937,902, and non-current assets probably, unless it's a trading security, in which case it would be a current asset. But assuming it's not, then that would be a long-term, a non-current asset. Okay, so not even their total assets changed. They only changed in form. Instead of having cash of 937, now we have a bond, 937. Okay. Now, from the perspective of the issuer, the borrower, liability, the discount is a contra liability. Debit balance. Little by little, as the unamortized discount, as the unamortized shrinks, what happens to the carrying value of the liability? It's going to be pulled up towards $1 million. Nothing to memorize. Okay, let's try another one. Determine the journal entry we're going to record on January 1, year 1. Here we go. January 1, year 1, we issued a 10%, $1 million, due in 4 years. Interest is paid semi-annually. Stop right there. $1 million times 10% times a half. We got a $50,000 coupon payment. 4-year term, paying semi-annually. I got 8 periods. I got a market rate of 8%. Market rate, 8%. 8 divided by 2, 4%. Present value factors, my present value factors, I've got to find N equal to 8, interest rate, 4%. Coupon divided by price, my yield. We offer the world, you can do this annually or semi-annually. We offer the world a coupon of 10. The world look at our bond and said, hey, we'll take less than that. If that's less, we sold at a what? A gain, a premium. That means my interest expense is going to be less than my coupon paid. My periodic interest expense is going to be at 4, less than my periodic coupon payment, 10 divided by 2, 5%. Ah, makes sense. Now, let me make sure I actually collect more than $1 million. So the present value of the principal, 4%, 8 periods. Present value of the principal. So is my present value factor of a one-time future payment of $1 million. What's the present value of the principal? 730, 690. Then I've got present value of the annuity, the coupon payments of $50,000 every 6 months for the next 8 years. Multiply that by 50,000, you get 336, 650. The sum of the two is your selling price. This is the sum of the present value of those future cash flows, your financing inflow, your proceeds on sale. 1,067,340, greater than the face value as predicted. So big picture now. Before you rush into a journal entry, cash just went up, 1,067,340. That is a financing inflow. The face value is where you always start. Now your initial carrying value has got to equal your selling price, your proceeds. So this is an extra 67,340. It is a gain, but we can't call it a gain. We have to call it an unrecorded and unamortized premium. Little by little, as we amortize the premium, watch this. Little by little, as that gets recorded. How is that going to get recorded? You will record premium over bond life by making the interest expense at only 4%, less than the coupon you're actually paying at 5%. That differential, Little by little, as we record the premium, the unrecorded amount shrinks. What's going to happen to the carrying value of the liability? It's going to get pulled down toward par over time. Okay, so your interest expense is going to be less than your coupon paid. All righty. So no memorization. You're thinking. So how again did we get the value of the bond, the selling price? We need our present value factors. Present value factors are always based upon what? Market rate, also known as what? The yield to maturity at issuance. We need the market rate, 8 divided by 2, 4%, 4-year term, 2 payments per year, 8 periods. Okay, we're looking for 4%, 8 periods. Present value of 1 for the principal, present value of annuity for the coupon payments. The coupon payments were $1 million times the 10% coupon rate times 1/2, $50K. That's how we get our present value factors. Once you have your present value factors, you find your present value of your principal, which is a one-time payment, present value of 1. Then you find the present value of your coupon payments, which is an annuity, multiple payments of the same amount. You get those present value factors, you multiply by the principal, the coupon payment, add it together, there's your selling price, there's your proceeds, and that is also the initial carrying value of the liability. Okay, since your selling price is greater than the face, we know we have a premium. We will record that by making our interest expense less than the coupon paid. The coupon paid will be based upon the periodic rate of 5. The interest expense will be based upon the periodic market rate of 4. As we record the gain, we'll be adding a smaller and smaller unrecorded gain, pulling the carrying value of the liability down towards par over time. Okay, so 50,000 present value factor of an ordinary annuity, not annuity due. But be careful with notes. The first payment might be due immediately. With leases, the first lease payment might be due immediately on the day you sign the lease. If the first payment happens now, beginning today, you don't wait to make your first payment. That is all principal being paid immediately. It's all principal. And then your present value factor is that of an annuity due. Okay, how are we going to get our interest expense? Your interest expense, the beginning carrying value of our liability, $1,067,327 times our periodic market rate, 4%. My interest expense is only $42,693. That's my interest expense. Yet the coupon I'm paying is $50,000. Well, by reducing our interest expense, you see how that benefits profitability? That's how we're implicitly recording a little piece of the gain. We just recorded, we just amortized how much of that premium, we just recorded how much of that gain just got recorded? $7,307. Now, you don't have to memorize. The carrying value's got to be pulled down. So we're going to take that $1,067,327 and we've got to subtract the $7,307 because the carrying value has to be pulled towards par value. If it's less than par, you got to add it. If the carrying value is greater than par, you got to subtract it. Nothing to memorize. And we know our interest expense based upon the periodic rate has to be less than the coupon paid, 5%. Okay, and you always record your interest expense using what? The market rate at issuance. Current market rates are what? Due to. It's due to. That's the professional AICPA term. Current market rates, due to. We don't like doo-doo. Don't step in doo-doo. Cross out the doo-doo. Get rid of the doo-doo. Wipe it off the bottom of your shoe. Don't drag it in the damn house like my freaking kids do. They walk the damn dog. They don't walk the dog. They just let it in the back. And then they forgot where the dog pooped, and then they start playing catch with the dog, and then they step in the poop, then they come in the house, and then they got the damn poop all over the house, and I gotta clean up the damn poop. And you know what that means? I'm screwed. Because even when I old, you think they're gonna remember this? You think they're gonna remember all the nice things I did? No, they're gonna put me in the cheapest ass nursing home, bring me some stale freaking cookies once a month and think that they're good sons, damn it. Woo, baby. All right, I'm sorry, where was I? All right, so the premium gets recorded over the life of the bond by making the interest expense less than the coupon paid. All right, so here we go. Bond is issued, you ready? When the bond is issued, you are the borrower. So this is a financing inflow. Assets go up. Premiums have a credit balance. They make the carrying value of that liability go up. The unrecorded premium, the unamortized amount. Okay, so assets up. The premium on the bonds payable. Liabilities up, bonds payable, liabilities up. What's your net increase? Your initial carrying value, net increase to your liabilities, initial carrying value has to be equal to what? The selling price of the bond, $1,067,327. Okay, as we add a smaller and smaller unamortized amount, premium's gonna go down. So as this gets amortized, you add a smaller unamortized amount, and thus the carrying value gets pulled down towards par. Sweet. All right, effective interest method. How do we record interest expense? You ready? So the effective interest method, from now on, when you see effective interest method, you think, hey, that's a constant rate when we calculate our depreciation expense, a constant rate. The coupon paid, no change every period. It's the face times the coupon, probably times a half. There's your periodic payment. I'm assuming it's semi-annual pay. Your interest expense is the beginning carrying value of the liability times the market rate when at issuance, not the current rate, that's due to, times a half. And there's your interest expense. Now think about this. You ready? If the bond is issued at a discount, the carrying value of the liability little by little will be pulled up towards par. Interest expense will be pulled up towards par. If the bond was issued at a premium, carrying value little by little will be pulled down towards the face. The interest expense will be pulled down. The only time the interest expense is constant with the effective interest method is if the bond is issued at par. Okay, amortization means to do what? To record. To record. All right, it's the difference between the interest expense on the income statement versus the coupon paid on the statement of cash flow. And everybody, especially my international students, where do we always put the coupon paid? Operating outflow. Okay, it's just calculating the difference between the interest expense on the income statement and the coupon paid. Okay, when you see discount, you think loss, carrying value of the liability would be pulled up. When you see premium, you think gain. Little by little, the carrying value of the liability pulled down towards par. Matches the match, it adheres to the matching principle so that the gain or loss is recorded little by little over the life of the bond rather than initially when the bond is issued, because that would violate the matching principle. When you've got a discount, bad news. Bad news, interest expense greater than the coupon paid. Premium, and this is from the perspective of the issuer, okay, not the investor, the issuer, the borrower. When a premium is received, that's good. We collected more than the face value. So your interest expense less than the coupon paid, okay? At maturity, the book value has got to equal its face value. That's why the carrying value is always pulled towards par. We amortize, record any discount or premium over the bond term. Why? Matching principle. We got to allocate that gain or loss over the life of the bond. Now, as a general rule, we'll be using method one of two, the effective interest method. Okay, that's a constant market rate at issuance method. You're using that same market rate at issuance the entire life of the bond. Now, sometimes the exception, you can use the straight line method, but only if the results are not materially different. It's got to be a relatively short-term bond, less than like 10 years, and cannot be zero coupon. All right. If it's a long-term bond, 20 or 30 years, you're not allowed to use straight line. You'll get a materially different results, straight line versus effective interest. If it's relatively a short-term bond, less than 5 or 10 years, go ahead. But you cannot ever use straight line for a zero coupon bond. You can't do it. Okay, and we'll see that in a little bit. Okay, straight line method, you ready? You take your discount divided by the number of payments, and this is how much you will add to the coupon each period so that your interest expense is greater than the coupon paid. If it's a premium, you will divide that by your number of payments. This is what you will subtract from the coupon so that your interest expense is less than the coupon paid. Okay. Carrying value, if the bond is issued, we're assuming a discount. Okay. If it's a discount, carrying value of the liability pulled up toward par. At par, what's this amount going to be at par? Face value. It's got to mature at face value. Interest expense, if you're using the straight line method, it's a constant dollar amount. The interest expense does not change. It's the exact same amount. At maturity, the bond matures at face value. Okay, that's a constant dollar amount, constant amount. Straight line, just like straight line depreciation, the dollar amount every year never changes. Same thing with straight line, discount or premium amortization, the dollar amount doesn't change. Effective interest method, which is the general rule. Okay, if the bond was issued at a discount, carrying value of the liability is going to be pulled up. As the carrying value of the liability gets pulled up, times the constant rate. But if the dollar amount goes up and you're multiplying that by a constant rate, the interest expense is going in what direction? Up with it. It's not a constant dollar amount. Interest expense goes up as the carrying value of the liability goes up. No matter what, the bond is going to mature at what? The bond is going to mature at face value. Okay, at maturity, the bond will always be at face value. But the effective interest method is a what? Constant rate. Straight line, just like straight line depreciation. The depreciation expense dollar amount never changes, nor does the interest expense. Okay, how do we get the interest expense under the effective interest method? Beginning carrying value of the liability times the market rate at issuance. When you issue it, there's your interest expense. If the carrying value is going up, your interest expense is going up with it, but the rate doesn't change. It's the rate when you issued the bond. Okay? So whenever you see, how am I doing on time here? I'm doing all right. Effective interest method, whenever you see that, you think constant rate. Okay, interest expense, if the bond is issued at a discount. How do you know it's issued at a discount? Selling price less than the face. The coupon, we offered the world 6, but the market said, nah, we want 8. So the bond is issued at a discount. We have a loss. As the beginning carrying value of the liability goes up, we don't change that market rate at issuance. Okay, the interest expense is going to be greater than the coupon paid. Okay, just watch the time period. Watch date of issuance. I'll show you examples of that later when the bond is issued between coupon payment dates. If the bond is issued at a premium, selling price greater than the face, your interest expense, the carrying value of the liability is going to be pulled down times that market rate at issuance. That doesn't change. So interest expense is going to go down as the carrying value of the liability goes down. If the carrying value of the liability is going up, your interest expense is going up. Effective interest method, constant rate. Okay. How do you know the bond was issued at a premium? We offered the world a coupon of 6. They said, no way. We want a rate of 9. How am I going to get you that bigger rate? Discount the price. If you pay a smaller amount, then you'll be able to earn 9% with that same payment. If you don't pay, the only way your yield equals the actual coupon rate is if you pay face value. If you don't pay face value, buy it at a discount, you're getting a bigger yield, a bigger return on that investment because you didn't pay as much for it. Okay. Now, on the CPA exam, students are typically asked to do what? Amortize, baby. So we are going to be ready for this. It makes for a great task-based simulation. Why? Multiple pieces of the puzzle. What's the cash proceeds upon issuance? Was the bond issued at a discount or a premium? Record your first period of interest. Record the amortization. Tell me the carrying value of the liability at the end of the period, whatever it may be. Okay, amortization of a discount or a premium. Discount is a loss. How do we know? The market wanted a rate greater than the coupon. Premium is a gain. The market was willing to give us a rate less than the coupon. Premium, selling price greater than the face. A loss, selling price less than the face. The more times you write it, you hear it, you read it, repetition, not rocket science. Okay, the market rate at issuance is what we use to calculate the interest expense. The rate is not changed. Current interest rates are due to interest expenses compared to interest paid. If the beginning carrying value of that liability is less than the face, then it's got to be pulled up. We add the discount amortized. We got to get the ending carrying value of the liability up closer and closer to face. If the beginning carrying value of that liability is greater than the face value, that's an ugly face. Let's try that again. Sugar. If the beginning carrying value of that liability is greater than the face, then you've got to subtract premium that is amortized, recorded. The ending carrying that value of that liability has to go down toward that face. Okay, it's always pulled towards the face. Okay, let's try it now. You ready? So let's do now, we've covered all the theory. Let's now take a look at an example. Here we go. So there's all the theory. Let's do it. So assume the same facts from the previous example. All right, I want my journal entries, June 30 and December 31st. We issued a 10% bond, $1 million, due in 4 years, semi-annual, stop right there. 4 times 2, 8 payments. 1 million times 10% times a half, $50,000 is my coupon paid. Okay, the yield, 12%, stop right there. We offered the world 10. The market wants 12. The price, it's going to be issued at a discount. The selling price will be less than that face value. Here's the 937,902. So we issued the bond. We collected 937,902. Face value, $1 million. My initial carrying value, 937,902. What's the difference? An unrecorded loss. 62,098 is the difference. That is your unrecorded, your unamortized discount. That initial carrying value of the liability has to equal what? Your selling price. Okay, so now we're ready to do our math. So every period, $50,000 coupon is going to be paid. So my initial carrying value of that liability, 937,902 times 12 divided by 2. Why? Semi-annual. Okay, 56,274. That's my interest expense, greater than my coupon paid of 50. Why the extra 6,274? Why the extra 2,000? Oh yeah, that's the amortization of the discount. That's a little piece of that loss we just recorded, 6,274. Add the 6,274. How do I know to add it? Because the carrying value's got to be pulled up towards par. So in 6 months, the carrying value of the liability is now going to be what? 944. 176 times 12 divided by 2. We do not care what current rates are. 56, 631. Wait a second. Interest expense is not the same number. That's right. It's a constant rate, but because the dollar amount went up, the interest expense went up because the carrying value went up. Greater than the coupon paid. 50,000. We just recorded another $6,631 of loss. Add that 6,631, and in 12 months, what will the carrying value of that liability be? It'll be pulled up again, 950, 827, and we just keep going and going and going. Carrying value pulled up, interest expense. I know it's got to be greater than 56,631. Coupon paid, not going to change. 50,000. It's it. You're going to get it right. But the most important thing is because you understand it, you're going to get it right, and you're going to get it right more quickly. Okay, so that's the key. The task-based simulations, and a lot of people, might be able to get the same question and do it correctly. But if it takes you 15 minutes and it takes me 30 minutes because I don't really know what I'm doing, that's the difference between success and failure, especially in FAR and BAR, where it's more math intensive. It's too much information to memorize. Understand it, talk it, write it, read it, watch it, you'll remember it. Pass it, and then you can forget it. All right, so there we go. You don't need to memorize this schedule. The market rate, 12 divided by 2, 6%. Constant rate will never change. My interest expense is going to go up as the carrying value of my liability goes up. Cash payment, constant. Difference between the two, oh yeah, I just recorded a little bit of that loss. I just amortized some of that loss. What's my carrying value now? No longer 937, 902. We just recorded 6,274, getting us 944. And then the process repeats itself. Interest rate, 6%. The market rate, greater than the coupon rate. That's why we have a loss. Okay, the market was demanding a higher rate than we were willing to offer. Beginning carrying value times the market rate, which doesn't change. That's the market rate at issuance. Therein lies our interest expense, getting higher as the carrying value is getting pulled up towards par. The 50,000 never changes. The 937, 902 is where we started. Then we added 6,274, got 944. Then we amortized 6,651, got the 950. Then we amortized, recorded another 7,050, and so on and so on. Eventually, at the end of the 8 periods, the face value should be what? $1 million. That will be a financing outflow. That'll be a one-time future payment. Payment of principal is what? Financing outflow. Okay, so at maturity, 4 years from now, 8 payments from now. Okay, interest expense greater than that coupon payment? Yeah, because we got a loss that we have to record over the life of the bond. Okay, journal entries. Interest expense makes your net income go down, which will make your retained earnings go down, which is going to make our equity go down. So let's make sure our balance sheet balances, and we understand a discount, the unamortized discount, that is a contra liability. It has a debit balance. So when you credit it, the unrecorded amount is going down. This is going to make the carrying value of the liability go up. Cash, asset down, operating outflow when you pay interest. Okay, so cash is down by $50,000. My liability is up by $6,274. My equity is down by $56,274. So the net change to the right-hand side of my balance sheet matches the net change to the left-hand side, a reduction of $56,000. As you amortize the discount, as the contra liability goes down, the carrying value of the liability goes up. Okay? Now, what if they messed with you? What about from the bondholder perspective? That really makes for a good task-based simulation. They just debited cash. They got a check for $50,000, yet their interest income is not $56,000, it's $56,274. $56,274. So from their perspective, that discount is your plug figure. That's going to get debited for $6,274. A discount is a contra asset to the bondholder, is a contra asset. It has a credit balance. All righty. So as we amortize the discount from the perspective of the bondholder, the carrying value of that asset is going to be pulled up towards par. So someday they're going to get a check for $1 million. Okay, so either side of the equation, we can get it. But this is what I was mentioning at the very beginning of today's class, the connecting of the dots. While we cover investments, when we cover assets, it's the flip side of the same coin, right? So you keep reviewing it. Make sure I know. Lease, is it the lessor or the lessee? In FAR, we predominantly look at it from the perspective of the lessee. Should you go on to sit for BAR, you'll look at it lessee, but more now the lessor. Okay, flip side of the same coin. Okay, next item, December 31, year one. Interest expense went up because the carrying value of the liability went up. Contra liability down, so the carrying value of the liability is up. Cash is paid, so cash is down. Net change to the right-hand side of the balance sheet, minus $50,000. Change to assets, minus $50,000. Right? Okay. Now let's talk about a premium. How do we know it's a premium? Selling price greater than the face value. They offered the world a coupon of 8. The market looked at this bond and said, no way, man, we love this bond. I'll take it for 5%. We're going to collect more. The premium is what? A built-in gain. Your interest expense is going to be less than the coupon paid. The carrying value of the liability is going to be pulled down toward par over time. This is the sort of stuff that when you open up your test slip 3, 4, or 5, first of all, legalize cheating. You're not going to work the problems in the order presented. You're going to cheat and see. Cheat. It's not really cheating. I want to see what the problems are because I'm going to work my strongest topic first, my weakest topic in that test slip last, because if I'm going to rush, let me rush on my crappiest topic, not my best. When I see it's a bond question, I'm immediately going to look at what the questions are, and then I see what the requirements are. I'm going to be thinking, well, yeah, what's a discount? What's a premium? What do I got to do? Okay, so all this we've covered. This is just regurgitating the same stuff. Let's do it. Let's practice the problem. You ready? So here we go. Same facts as before. They tell us journal entry June 30, December 31. Issued a 10% $1 million bond due in 4 years, semi-annual pay. Stop right there. 1 million times the 10% divided by 2. 50,000 is my periodic payment. 4-year term, 2 payments per year, 8 periods. The market rate is only 8. 8 divided by 2. Present value factor 4%. 8 periods. Let's see. The market wanted a rate of 8, we offered them 10. They were willing to take less. I better get a selling price greater than face value when I calculate my proceeds on sale, and I do. $1,067,000, same number we saw earlier. Okay, so we've got our $1,067,000. So we're thinking, okay, my initial balance sheet, financing inflow, $1,067,327. Financing inflow. Someday we got to repay only $1 million. That's why it's a gain. We scored. Initial carrying value has to be equal to your proceeds on sale. So that's easy. There's my initial carrying value. What's the difference? Oh, I got to add 67,327. Selling price greater than the face value. Oh yeah, that's my unrecorded gain, my unrecorded premium. Got it. As I record it, carrying value of the liability be pulled down towards par. So at June 30, beginning carrying value, 1,067,327 times my periodic market rate, 4%. I've got interest expense of 42,693, which is less than the coupon payment of 50,000. Hey, what's that difference? Oh yeah, I just amortized $7,037 of that gain. This number 67 is going to go down, so my carrying value is going down. So I subtract 7,037. So at the end of the year, what's the carrying value now? 1,060,030. 1,060,030. I can't read my own handwriting. I think that's an 020. Okay. So now multiply that by 4%. What's my interest expense at December 31st? Well, if my carrying value went down, my interest expense should be lower than 42,693. It is. I get 42,401 because I got a constant rate, not a dollar amount. That again is less than my $50,000 payment. How much of that premium did I just record? Another 7,599. I know I got to subtract that because this carrying value's got to be pulled down towards par. As that goes down, the rate doesn't change, but my dollar amount for interest expense will go in the same direction as the carrying value, and so on and so on. So, 1,067,327, my initial carrying value of the liability, equal to my proceeds on sale. I subtract the 7,307. What's the carrying value now? 1,060,020. That got pulled down. The market rate, we use the market rate at issuance. Current market rates are irrelevant. Difference between the interest expense and cash payment is the recording of that gain. Okay? So, period after period, every 6 months, as the carrying value goes down, constant interest rate, the interest expense goes down, the cash payment, no change. Every period, the carrying value of the asset is being pulled down so that at maturity, the face value is what amount? $1 million. That'll be a one-time payment, and when we pay it, that's all principal, financing outflow. Okay, that's 4 years from now, 8 payments from now. So, what's our journal entry? We record our interest expense, net income goes down, retained earnings goes down, your equity goes down. The unrecorded premium goes down. Okay, that's a contra liability. Okay, that's a liability. It has a credit balance. It increases our liability. As we amortize the premium and reduce that unrecorded gain, the carrying value of the liability goes down. My asset goes down when I pay the cash. So, cash is down $50,000. Okay, my retained earnings, my equity is down 42,693. There's my cash paid. Carrying value of the liability is down by 7,307. Right-hand side of the equation, down by $50,000. Equity down, liability down. Left-hand side equals the right-hand side. If you were the bond holder, if you were the investor, it's the flip side. You're going to debit cash for $50,000. Okay, you're going to credit interest income for the same thing that they're going to credit interest expense for, 42,693. And then you're going to credit your unamortized premium. We want the carrying value of that asset to go down. We issued it at a premium. So that would be 7,307. Carrying value of the asset's going to be pulled down from the bondholder's perspective. Okay, so assets are down by $50,000. Okay, excuse me, assets are up by $50,000 from the perspective of the bondholder, the investor, the supplier of the capital, the bondholder. This is a cash flow investing. They get a check for $50,000. That makes assets go up. The carrying value of the asset just went down by $7,307. Their net change to assets, therefore, is up by $42,693. Equity is up because the interest income is up. That makes retained earnings go up, $42,693. Okay, flip side of the coin, whether it's from the perspective of the bondholder, the investor, the supplier of the capital, they probably have an investing outflow when they buy the bond. All righty. Last item here, as the interest expense, again, from the perspective now of the borrower, the issuer, as the carrying value of the liability gets pulled down, the interest expense goes down. The cash payment, no change. Your plug figure is what you have to do to get your journal entry to balance. The unrecorded premium, the unamortized premium, you're adding a smaller and smaller amount. That makes your liability go down, pulled towards par. Net change to liabilities, minus 50,000. Net change to assets from the perspective of the issuer, they wrote a check, $50,000. And remember, operating outflow, my US students, all students, but especially my international students. Woo, baby. All right, here we go. Charlotte, it's all you. Don't go away. When Charlotte's done, we're going to talk about bonds issued between interest payment dates and bond issue costs. So don't go anywhere. Charlotte, it's all you. Here we go.
Maybe, yeah, I'm laughing. I think that this officially puts me as like the intermission, right? That's kind of where we're at, a little bit of a break. But I will say, be careful. You had me cracking up with your dog, with your sons and the dog doo-doos. You know, you better be careful, or they are going to put you in a nursing home. So you better.
I wish I was joking. I'm serious. I'm serious though, Charlotte.
No, it's for all real. It's exciting to be here with you all today. So what you can expect a little bit from me is if you are already in the UWorld course and you're just here enjoying this bonds lecture, thank you for investing in UWorld and for trusting us to help you pass the CPA exam. If you have not invested in yourself yet and started this big CPA exam process, love to share a little more information with you about UWorld and some of our course features, many which Peter has already highlighted today. So let's start with the 2026 UWorld CPA Review course. First and foremost, most important, all of our study materials have been updated for the 2026 CPA exam. So that means every area, all the questions, the books, the videos, you are going to always get the latest and greatest from our CPA Review Prep program. Everything is going to be clearly mapped to the AICPA blueprint. So I'm going to show you an example here of that in a minute. You guys have already seen that with the examples from Peter. This is a testament to how all of our lectures in the course, our books, our questions, everything is pointing back to the CPA exam blueprints. Expert team of accounting educators, practice CPAs across the board. Everyone teaching within the course and writing our content is a CPA, and a proven methodology resulting in a 90% pass rate, which I'll share here in a moment with you all. That beautiful circle to the right, what is that? Well, the lack of better words, UWorld's kind of assembled the Avengers of CPA review. Pete, you can choose if you're Captain America or the Hulk, or which character you are today. But you'll see there with the acquisition of Rogers CPA Review a few years ago, and then behind that, Wiley Efficient Learning, so the Wiley CPA Review Prep course. Obviously, Peter Olinto, proud to have him join our team a few years ago. All of that times to the UWorld's proven method, including Megan, as Peter gives a shout out there, is all invested to ensure your success on the CPA exam. So as far as our instructors go, you're getting some of the best today, if not one of the best industry favorites. Okay, I have to say full transparency, I'm not used to talking here with Peter drawing on Roger. This is
I'm sorry, am I screwing you up?
No, not at all. I'm just actually laughing, and I really hope that he watches this session as you're getting him ready for Halloween as what I think is a pirate. So industry favorites, including Roger and Peter, featured throughout our course. However, on the next slide, you're also going to see, as Peter previewed, Dr. Megan Burke, who's joined us today, and a wide variety of other instructors, either key educators at their universities. You'll also see Dr. Youngberg and Dr. Carnes, their head instructors, head authors of some of the top tax textbooks, for example. And then I actually believe we have Jeannie Yamamura for a future other webinar event. So all of the best, only the best for our UWorld students, making all of this come to life for you. So beyond our full team of experts, for our next slide, one of the #1 questions that we get is, how do I know if I'm exam ready? Specifically, we survey our students, and the AICPA survey students all the time. The content's difficult. You're seeing that today with Peter. However, you're going to know the content because we're going to teach you the content you need to know for the exam day. But beyond that, it's a major time management is going to be required of you as you're going through this process. So in order to help you with that, we have created the UWorld Study Planner. So if you're joining us today again and you're already a UWorld student and you haven't been leveraging the planner, you absolutely should. So how does it work? You log into your UWorld course and you basically say, I'm going to start studying on this date, and then my exam date or my exam goal is going to be this date. So you lock them both in on the calendar. And then beyond that, if you go to the next slide for me, Pete, you then put what's reality for you. So we're going to ask you, how many hours can you give us here at UWorld, right? You've got to be really realistic with your approach. So you'll see in this example, I've got 18 hours. I don't want to study on Sunday. I can give you a couple hours on Monday, Tuesday, and so on. You basically lock it in. You'll also recognize too that we really advise you at least one of those days to do a 4-hour stretch, because we got to get you ready for the real deal with your 4-hour exam. But you put in your wish list and you say, UWorld, this is what I've got. This is the amount of time I can give you. And the study planner is going to let you know if the time you're able to balance and the material you've got to go through are going to match up with reality to ensure that you're truly ready to sit on your ideal exam date. So very prescriptive, everything from assigning you the lecture videos, the areas of the book to read, and the practice questions. You're going to have a very clear path with our dynamic study planner. So next slide, I mentioned part of the study planner is going to assign you the lectures with our key instructors like Peter. You're going to also be assigned key components within the lecture, the textbooks or the study guides. So in this example, this is a snapshot from financial statement analysis. And what you'll see that you've already been seeing throughout Peter's lesson today is every lesson is going to start out with, what is the blueprint in front of you? Are you going to see this as a multiple choice question? Are you going to see this as a task-based simulation? And here is exactly how the AICPA is going to test you on that particular topic. If it's not in the blueprints, it's not just extra material in the course. We're not including it. It's very easy for any candidate to take the blueprints and map it one-for-one with all of our material. But alas, you don't have to do that because we've already done that work for you. So next slide. You'll also see favorite is going to be the UWorld questions. So UWorld, what we really drive forward here is that it's an active learning experience. We don't want you just memorizing, but we want you to understand the concepts that you're learning, because as you get to the exam and that 4-hour test, you're going to have to move through the material very quickly. And FAR, for example, what we're learning from bonds today, it's a difficult topic area. So we want to make sure that you're not gaming the system and just memorizing, but that you're actually understanding what you're being taught so you apply it on exam day. So questions are going to match the exact format of the Prometric Testing Center. You're going to get immediate feedback. So that feedback includes what percentage of other UWorlders selected that same answer. So you'll definitely feel in community. And then you'll see on the right our vivid answer explanations. So UWorld way, we're going to start out with some sort of an illustration, a graph, a drawing. These are going to be the same images that you're going to see in the lecture videos and in the textbook to build upon the concepts. We're really going to help that come to life, especially for our visual learners. Then you're going to get an in-depth answer explanation. So it's going to affirm why the correct answer is correct, pat yourself on the back. But then you're also going to get why the 3 alternatives are wrong. So in this example of our multiple choice, the reason why this is so important is because I don't know about all of you, but I know when I was studying as a student, I needed to know why I got an answer wrong so that I didn't keep applying the same logic moving forward. So that's really important at UWorld and really sets us apart from other review providers. Lastly, things to remember. Again, we're going to tag every single component back to the blueprints. And at the very bottom of that answer explanation, you'll see every single answer is tagged to its lecture video. So for example, you watch the lecture with Pete, you come start practicing the questions, you start kind of hitting a couple roadblocks, you're having some trouble, you're not getting the answers correct, pause, time out, click on the lecture video, hop back into the video and review this concept again before you pick up back into the questions. Okay, so next slide. So one of the areas we love feedback from our students, and one of students is in UWorld students, and one of the big areas that we consistently hear feedback for are the TBSs. The TBSs are hard, as Peter was showing an example. So we have dedicated 2 resources to help you really focus on the TBS. The first you'll see in study resources. These are going to be videos that are going to help you really no matter what the question is asking. So for example, it might say you're in FAR with a document review simulation type TBS. Here is strategically the best way to address that type of a problem. But then on the right, you're going to see our new TBS mastery videos where these are specific one-to-one for TBS. So you're going to open up the TBS problem, you're going to start working through it, and then we're going to have a video in this example, a face that we're all knowing tonight with Dr. Megan Burke. She, in these examples, is walking you through start to finish how to look at this TBS, where's the areas they could be trying to throw you off, how to word it, what order you should answer in to really ensure that you master the strategy for really acing those TBS questions. Because as mentioned, they're difficult, they're meant to be, but we're going to get you through them. So next slide is going to be our CPA exam smart path. So this one's great. Oh, not smart path. It is our boot camps. So forgive me. So you're all seeing, it's all right. You're all seeing an example of our boot camps. So our live CPA boot camps, this one's a freebie for bonds tonight with Peter, are featured throughout the course with Peter and our other instructors as well. These are a great live component, about 1 to 2 hours, where we're going to focus sessions on highly tested exam topics. And what's also really great is if you can't make a particular session, you can always catch the recording afterwards. So great opportunity to join a live element within the course. Now we're going to get into Smart Path because I was getting a little too excited about it. So UWorld Smart Path is going to ensure you are exam ready. So you lock in with your study plan. That's going to help you with your time management. But how do you know you're really ready for exam day? Smart Path is going to provide key targets for you. So every chapter, in this example, audit basics and engagement planning for the first chapter, you're going to be given 2 targets. You're going to be given target proficiency or your score. Are you showing us that you're understanding the material? And question number attempted. Have you practiced the right volume? And it does not mean that you should practice every single question in the Q bank. We got to make sure that you practice the right volume. Those 2 targets are set by candidates that have already passed using UWorld within the new evolution exam post January 2024. So we basically take the path that they took, the smart one, and we give you those same targets to hit as you're working through the material. Once you hit those targets, the system is going to encourage you, as Peter wrote, yes and yes, targets met. It's time to move on to the next chapter. So no guessing game that you are ready for the big day with the CPA exam. All right, next slide. Due to Smart Path, you'll also have your mock exams and your exam sims. So these are going to be even closer to the big game day here with sitting for the exam. Exam simulator, you can practice as many times as you want. That's where you're going to draw questions from the question bank. It's going to serve it up exactly as Peter mentioned, testlet 1, 2, 3, 4, 5. We're going to ensure that you're starting to really get into that test environment mindset. Our instructors in the course are going to encourage you, take your smartwatch off, get rid of the phone, put a sign on the door, really lock into what that 4-hour jam is going to look like. And then we also now have our mock exams. So mock exams are brand new questions. You've never seen them before. It's going to be a 4-hour mock exam, and you're going to get some great feedback on kind of your strengths and weaknesses after you complete those 4-hour mock exams within the course. Next slide, UWorld students, we are very, very proud of our students achieving that and with that 90% pass rate. So how did they do it? For example, Kayla here, what do you need to do in UWorld? You achieve at least 75% of your topic areas Smart Path targets, check. You work at least 75% of the question bank, so the right volume, not the entire bank. And then you create a minimum of 100 short practice quizzes, and you got to study for at least 60 days, right? This isn't something you decide, I'm going to start studying tomorrow and sit for it for next week. So you put all those together, and we're exceptionally proud that our students are passing the CPA exam with that 90% pass rate. So for lack of better words or fancy words, you do what we say, proven results, we're going to get you to pass the CPA exam. To get you started, my last and final slide, before we turn it back over to Peter and get back into bonds, if you have not invested in yourself yet, and you are ready to make that jump into the UWorld Elite Unlimited CPA Review course, I'm very excited to share with you a discount code. You'll see there it's FAR Lecture. You can scan that QR code. It's going to drop the price on the Elite Unlimited even more than any website promo that we're running. The Elite Unlimited course is going to include everything you need to pass the CPA exam. So all the books, all the blueprints, all of the questions, the Smart Path, the live events, the mastery videos, and even more that I did not cover today. So as Peter's pointing out, all of that is an unlimited subscription until you pass. So you don't have to worry about that clock ticking. We're going to be with you all the way through until you get all 4 sections of the CPA exam passed. So with that, thank you very much for your time. I'll be sticking around until the end if you have any questions on our courses and packages. But I'm going to turn it back over to Peter. And Megan, I see you're also here.
We have one question that Pete needs to answer, which is, if Peter Olinto was an Avenger, who would he be?
I would be Captain Dumbass. Is that an Avenger?
I haven't seen him in a movie yet, but maybe he's getting one soon.
Yeah, I don't know if that's going to be a box office hit, Pete.
I got issues. My father, when I was growing up, his nickname for me, stupid ass, you stupid. I wish I was joking, man. Oh, my father, man. He had 4 kids. I was the 4th. He wanted 2. And then there was an oops, and then there was another oops. When you're the second oops, you got problems. So I would be the, why am I telling you this? We're all close now. That's all right. All right, thank you very much. All right, so, all right, listen. Straight line method amortization is too easy. We don't have a lot of time left. I don't want to waste your time. You join the course. I'll show you this easy stuff. This would embarrass you. So we're not going to do straight line amortization. That's just zero coupon bonds is nothing more than a deep discount. Why is it a deep discount? Coupon is 0, yet there is a cost of borrowing, which is your yield, which is going to be a lot higher than 0. So your selling price is going to be well below your face value. As it says, there are no coupons paid. But are we recording interest expense? You bet. Why are we recording interest expense? Because we are accrual basis, not cash basis. Well, how the hell am I going to record interest expense if there's no coupon? Oupon. I'm thinking of udon. I'm thinking of some noodles I'm eating a little bit. How are we going to record interest expense if there's no coupon paid? Because we're going to take the beginning carrying value of that liability. We are going to multiply it by that actual cost of borrowing, that market rate. And that's how you're going to record your interest expense. And if there's no coupon paid, then 100% of that interest expense is going to be amortization of that deep discount. So let's take a look. 0 coupon bonds. You ready? Your selling price is going to be well below that face value. Again, we know why that is, because there's 0 coupon. There's nothing. All that interest is going to be amortization recording of that discount, okay? So not that big of a deal, but zero coupon bonds. No cash is paid, so there's no operating outflow. There's no operating outflow. Okay? Zero coupons pay no interest, but interest expense is still recorded because we are accrual basis. The entire amount of interest every period is amortization of that discount. All right, so that's 100% amortization of the discount. GAAP requires that interest is recorded, imputed. How do we do that? Beginning carrying value of the liability times that market rate at issuance, and therein lies your interest expense. That is also the discount that gets amortized. So we will take that interest expense every period, add it to the carrying value of the liability. And the carrying value of that liability, little by little, is going to be pulled up as we amortize that discount. All right, so let's take a look at an example. January 1, year 1, Indiana Inc. issued 400,000. As soon as I see zero coupon, I'm thinking deep discount. Okay, there's no coupon payment, so there's no present value factor for an ordinary annuity. There is no annuity. We just need the present value of the principal, the one-time payment. So we only need one present value factor, and that is the present value of that one-time payment we're going to make in the future. All right, so our actual cost of borrowing, while the coupon is zero, the market's not going to lend you money at zero. They want a yield of 5. That means the price will be well below face value. Okay, now the bonds mature when? In 20 years. So present value factor is based upon what? Our term, but there's no coupon payments, term 20, and our market rate. We're going to multiply this by the face value, 400,000. And what is going to be the selling price of this bond? 150,756. That is going to be your proceeds on sale. So as always, big picture, my financing inflow, my cash collected, 150,756. Yet my eventual repayment, that will be my financing outflow someday. My initial carrying value is always equal to my selling price, well below my face value, well below. What's the difference between 400,000 and 150,756? That is the unamortized discount. That is my future interest expense. 249, 244. That is my future interest expense that we're going to record little by little over the life of the bond. As we subtract a smaller and smaller amount, what's going to happen to the carrying value of the liability? Pulled up towards par. Okay, so that 249, 244 is your future interest expense that will get recorded over the life of the bond. We will start with the beginning carrying value of our liability, 150,756. Multiply it by 5%, 7,538 is my interest expense. Greater than my coupon paid, 0. So this is all amortization of that initial discount. This then gets added, 7,538. What's happening to the carrying value of our liability being pulled up? 158,294 times 5%. What's happening to my interest expense? If the carrying value of the liability is going up, my interest expense is going up. 7,915, constant rate, but the dollar amount changes. 7,915 greater than the coupon paid, 0. So this will then get added, and so on and so on and so on. Okay, so that is a deep discount. Again, we only need the present value of 1. That's it. No present value factor for an ordinary annuity needed because there's no coupon payments. All right, so this is financing inflow. Financing inflow, that is my selling price, also known as your cash. Proceeds, that is also the initial carrying value of the liability, okay? Present value factor of a one-time future payment using the market rate and the term. Okay, the discount. What is that discount? Well, right now that is unrecorded. That is going to be my future interest expense that we will get recorded over the life of the bond. So $400,000 is repaid at maturity. Okay. The principal is $150,756. That's what we borrowed. Yet my interest will be the $249,244. Okay, that will be repaid over the life of the bond. All right, so that $400,000 is both principal and interest. All righty. Now, on the statement of cash flow, though, this is all financing outflow. Why? There are zero coupon payments. With zero coupon payments, there's zero operating outflow. There is no cash outflow from operations. The entire $400,000 on the statement of cash flow, which is cash basis, that's all financing outflow. Yet we know in reality, per the income statement, $294,244 of that is going to go on the income statement little by little over the life of the bond. The rest is the repayment of what we borrowed, the $150,756. Okay, so one journal entry at maturity. That's it. Okay, after we issue the bond, the first thing is we got our financing inflow, we got the discount, the contra liability. This makes our liability go down. Bonds payable makes our liability go up. Net change to assets plus $150,756. Net change to liabilities a plus $150,756. The discount from the perspective of the issuer, contra liability. Okay, we record little by little that interest expense based upon the market rate. 5% is the market rate. The cash payment, 0. So it's all amortization. We start off with the $150,756. Little by little, we add our amortization. And that's how the carrying value of the liability gets pulled up towards par over the life of the bond. Okay, straight line could not be used. Zero coupon bonds. You're not allowed to use straight line method. Straight line method for amortization is only allowed if it's relatively immaterial relative to the effective interest method. Okay, so other than when we collect the cash, okay, there's only one cash payment at the end. That's it. There's no periodic coupon payments, but we're not cash basis because we are accrual basis. Even though no coupon paid, there's no cash inflow except when we issue it. There's no cash outflow until we repay it. But in the interim, we have to record our interest expense. That makes the net income go down, which makes your retained earnings go down, which makes your equity go down. As we amortize, as we record the discount, the contra liability goes down so that the carrying value of the liability goes up. The left-hand side of the equation, assets, no change. The right-hand side of the equation, no change. Equity down, liabilities up. So no change to total assets, equity down, liabilities up, that cancels out, left-hand side equals the right-hand side. Okay, now let's talk about bonds sold between interest payment dates. Bonds sold between interest payment dates. This is where it starts to get interesting. Okay, watch those dates, like depreciation. Okay, whenever you do depreciation, if you buy that asset during the year. You're not going to take a year's worth of depreciation. If you borrow money during the year, if I didn't borrow the money until July 1, I'm not paying you 12 months worth of interest. Okay, so interest expense, you got to be very careful. Now, bonds issued between those interest payment dates. You ready? Between interest dates. So what I'm going to call the accrued interest, the accrued interest prior to sale paid to seller. Okay, buyer pays upfront for coupon that belongs to seller. I'll show you exactly what I mean by that. You ready? So let me just make up dates here. What if the bond pays interest semi-annually? It pays interest on January 1, July 1, and then next July. What if the bond is issued, not on January 1 though, the bond is issued February 1. This is the date it's issued. Now the coupon paid is going to be for all 6 months. That's right, it's going to be for all 6 months. Okay, but 1 month of that, the seller, the borrower says, wait a second, I got to pay you 6 months? That's not right. I didn't issue the bond until February 1st. So the buyer is going to pay the seller in advance for that 1 month's worth of interest. There's going to be 5 months of interest expense, yet the coupon paid is going to be for all 6 months. Now, accrued interest here in this setting, but when the bond is sold between interest payment dates, that is really the accrued coupon payment. It's really the accrued coupon payment. All righty. So what's going to happen is when the bond is sold by the seller to the buyer is going to be paying for two things. The buyer pays on February 1 for the price of the bond and 1 month of coupon. They pay the price of the bond, which is based upon your present value of 1 for the principal, present value factor of an ordinary annuity. For the coupon payments, no change. But then they also pay 1 month coupon to the seller when they buy the bond. And the reasoning is because on July 1, even though they only bought the bond on February 1, how many months worth of coupon are they getting? 6 months. Now the seller is only going to record how many months of interest expense on the income statement. They are only going to record 5 months worth of interest. Okay, so that's the theory. Now how the hell do you do it? Watch this example. If you can handle this example, you got it. Delaware issued. And if you're not a square from Delaware and you got on clean underwear, put your hands in the air, say, oh yeah. What was the line? And if you're not a square from Delaware and you got on clean underwear, and if your mama ain't on welfare, scream it out and say, oh yeah. I don't know. These random things come to my mind. So my father used to call me a stupid ass. All right, Delaware issued $8,000 of 8% bonds on March 1, year 1. Watch the dates. They pay interest each June 30 and December 31st. Stop right there. They pay interest June 30. They'll pay interest again on December 31st. When was the bond sold? March 1. So January, we got February 1, we got March 1. That's when it's issued. All right, all of March, all of April, all of May, all of June, we're going to have 4 months of interest expense. We've got 2 months of accrued interest for the coupon. All 6 months of coupon will be paid on June 30th, even though the guy only bought the bond on March 1st. We're still going to pay him 6 months worth of interest. All righty, so they tell us the yield rate is 8. All right, stop right there. 8 price, yield to maturity, also 8. So the bond is being issued at what? Par value. Selling price equals par value. Proceeds 8,000, par value 8,000. Okay, so we do our, on March 1st, we collect 8,000, financing inflow 8,000, but we're not done yet. That's just the selling price of the bond. What about the coupon? You ready? What about the coupon? We got the selling price of the bond, 8,000. Okay, 2 months worth of coupon. You ready? We've got $8,000 face times 8% times 1/2. So $8,000 times 8% times 1/2. How much is that? Well, let's see. That 8,000, so that would be 800 if it was 10%. So 6,400. So we got $320. Okay, that is your periodic coupon payment. Okay, $8,000 face value times 8%. But now I only want 2 months worth of interest. 2 months worth. 2 months of coupon payment. Okay, what's 2 months of the coupon payment? Well, let's see. 2 months. Oh, I can't read my own handwriting. Petey boy, let's go. You're the only one. You think you're the only one who can't read my handwriting? 8,000 times 0.08. All right. Now we got 2 months worth of interest. So paid by buyer to the seller. Okay, so the coupon payment is $320. 6 months worth of interest. So that's going to be a payment of $320, $320. Now 2 months, 1/3, 2/6, whatever you want to do, that's $107 approximately. I believe it's exactly, that's why I can't read it. $106.67. I'm just going to round it to $107. So this is $107. 8,000 face times 8% times 2 months worth of coupon payment, $107. What's incredibly important to realize is not only does the buyer have to pay this $8,000 for the bond, but they also have to pay $107 for the accrued interest payment. Okay, it's really the accrued coupon payment. So the buyer pays in total. Buyer pays seller in total. Selling price of the bond, and it's sold at par, which was par, 8,000 plus 2 months worth of coupon, $107, for a total of $8,107. Okay, so we're going to do a couple of journal entries: March 1, June 30, and then December 31. So we have 3 journal entries to do. Okay, when the bond is issued, then on June 30, and then on December 31st. Okay, now remember, since the bond is issued at par, interest expense, coupon payment, they're going to be one and the same. Okay, one and the same. All right, so let's take a look now. Ready? I don't like the 1/3. I like 2/12. It's accrued coupon payment. There's nothing wrong with the 1/3, but I like to do it this way. Bond was, and let me just make it a little bit bigger. So we got June 30. We got December 31st. So 6 months, 6 months. March 1, issue date. 2 months of accrued interest, 4 months of interest expense, but no matter what, we're paying 6 months worth of interest. Okay, so I'd rather do the face value, 8,000, times the coupon rate, 8%, times 2 over 12, same result, but this makes more sense to me intuitively. Okay, so buyer pays selling price of bond, which is based on your present value factors, which we don't need here because since the coupon and the market rate are the same, that's $8,000 plus buyer pays seller. Buyer pays 2 months. And again, although it's called accrued interest, it's really accrued coupon. 107, $8,107. Okay. Now, what is the journal entry from the perspective of the seller of the bond? Okay, so if you're the seller of the bond, you're debiting cash $8,107. Okay, this $107 you're going to pay. It's an interest payable. You'll be paying that on June 30. That'll get paid. So that's a current liability. You have interest payable. All right. Then you got your bond payable of $8,000. Does that make sense? So from the perspective of the seller of the bond, you get the selling price of the bond, which here happens to be face value, but it would still be based upon your present value factors as always. Okay, $8,107, you debit cash. Interest payable, $107. Bonds payable, $8,000. Okay, now 8,000 times 8% times 6 over 12, $320. We'll be making a coupon payment here, $320 payment. We'll be making a $320 payment here as well. But the interest expense at June 30th is only for how much? 4 months. On June 30th, what you record on your income statement, since you borrowed the money on March 1st, you're going to be recording 4 months of interest expense. That's it. Okay? So at June 30, first payment, we're going to record 4 months of interest expense. So $8,000 times your market rate at issuance, which happens to be the same as the coupon rate, 8% coupon, 8% market rate, but times 4 months worth of interest. Okay, so you're only going to record, and that's from March 1 to June 30th, 4 months interest expense. All right, so we're going to record 4 months of interest expense. Of course, I can't read my handwriting, so 8,000 times 8%. Come on, man. Times 8%. $213.33. Okay, 8,000 times 8% times 4 over 12, $213.33. We're going to debit that interest payable. The 2 months the seller collected from the buyer, which was approximately $107. I know it's $106.67. Okay, so we're going to debit interest expense, debit interest payable, and then cut a check, credit cash, $320. Where did we get the $320 from? $8,000 times 8%, your coupon rate, times 1/2 semi-annual pay, $320. Okay, that would be our journal entry at June 30th, the first payment. So notice, very important, when bonds are sold between interest payment dates, find me how much, although they call it accrued interest, it's not accrued interest expense. It's accrued coupon that the buyer has to pay to the seller, and then the seller's going to wind up giving that money back when they make the first coupon payment. Okay, so the buyer of the bond pays the seller for the bond $8,000. Then they reimburse, they pay up front for the 2 months worth of coupon they'll be getting in a few months, $107. So the seller debits $8,107, but the bonds payable is $8,000. The $107 is interest payable. That is a current liability because that's going to be paid in 4 months. Okay, so that's a current liability. At June 30th, first payment, we record 4 months of interest expense, 8,000 times 8%, 4 months. We get rid of that interest payable. We credit cash for $320. Okay, what about at December 31st? Then you have your normal journal entry, debit interest expense, 8,000 times your market rate, 8%, times a half, 320. Credit your cash for your coupon payment, 8,000 times your coupon rate, one and the same, 8% times a half, 320. Okay, that's about as difficult as it can get. You got your journal entry when the bond is issued. The buyer pays the seller up front because 2 months worth of that interest, that buyer is not entitled to, but they're getting it anyway because the coupon is not going to be changed. We're still going to cut a check for 6 months worth of coupon, but 2 months really belongs to the seller. So the buyer pays the seller for that up front. Okay, first coupon payment, you make the full payment. Some of that is interest payable. Okay, you reduce that interest payable, you cut the check. Interest expenses only though for 4 months because you didn't borrow on January 1, you borrowed March 1. Okay, so date of issuance, 8,000 plus the 107. Interest payable, 107, bonds payable. One's a current liability, one's long-term. Be careful. Long-term liabilities do not go up by 8,107. Okay, so just be careful with that. June 30, interest expense, 4 months, 8,000 times the market rate, which happens to be the same as the coupon, I know, but I want to emphasize that's based upon the market rate, times 4/12. The accrued interest payable, that's 8,000 times the coupon, which happens to be 8%, same as the market rate, times 2/12. January 1 to March 1. Okay, cut a check all 6 months. 8,000 times the coupon, 8%, times 6/12 or 1/2. Okay. Remember, even though you are cutting a check for $320, okay, that is not your interest expense. The first payment, 4 months of interest, 2 months of accrued interest payable for a 6-month coupon payment. That's like the big deal. At December 31st, that's just your normal payment. And they happen to be the same because your interest expense, your market rate, is the same thing as your coupon rate. Okay, same thing as your coupon rate. All right, so year-end bond interest accrual. Again, watch your dates. This is not being so much the bond being sold between interest payment dates. Now we've got a bond where maybe the interest is not being paid, on December 31st. Okay, so again, matching principle. All right, matching principle. Now this is actually your accrued interest expense, okay, not accrued coupon. That's when the bond is sold between interest payment dates. Okay, that's actual accrued interest expense. Now, let's try an example. They tell us 900,000, 6% bonds. The bonds pay interest. Look at this, April and October. The yield is also 6. So coupon, price, market rate, 6, coupon 6. So when I issue the bond, I'm collecting 900,000. That's my financing inflow. I got to repay someday 900,000. This will not change. The carrying value of the liability is already at face value. So the carrying value of liability is already at face, so no change there. All righty. So they tell us, let's see. 9% bonds. Okay, the bonds are issued January 1, year 1. So January 1, we're going to debit cash, 900,000. Credit bond payable, 900,000. Assets up, liabilities up, long term, equity no change. Okay, now April 1, we're going to record 3 months worth of interest expense from January 1 to April 1. All of January, February, March, 3 months worth of interest expense. They're asking us about December 31st. Well, let's see, October 1. From April 1 to October 1. All of April, May, June, July, August, September, 6 months of interest expense. But now we've got from October 1 to the end of the year, it's a calendar year, at December 31st, from October 1 to December 31st, must record 3 months of interest expense, even though coupon not paid until April 1, year 2. So that's the big deal there. All right, so December 31st, this is what they want. 3 months of accrued interest. You're going to debit your interest expense, credit your interest payable, and that'll be for 3 months worth of interest. Okay, and then April 1, we'll do our adjusting entry, we'll pay the coupon. So let's do it. Ready? 3 months of accrued interest. Watch the dates that they're asking about. So from October 1 to December 31st, that's 3 months worth of interest. How do we record the interest? Beginning carrying value of the liability. I realize it was issued at par, but you always do it the same way. 900,000 times market rate at issuance, 6%. We're going to record 3 months worth of interest. 3 months worth of interest, okay? So we are going to accrue for 13,000. Sorry about that. We are going to accrue. Why won't my pen write? There we go. $13,500 of interest expense at December 31st. Okay, so that would adhere to what? Matching. Even though we're not paying it, we will record it. We will debit our interest expense, $13,500, credit our interest payable, $13,500. This makes net income go down, which will make retained earnings go down, which will make equity go down. This will make current liabilities go up. Balance sheet is in balance. Okay, so accrued interest payable for 3 months. Remember, this is interest expense is based upon what? The market rate. Interest expense, that is the market rate. And I realize here again that the market and the coupon are one and the same, but the market rate dictates the interest expense. So at December 31st, year 1, use market rate to calculate your interest expense, credit your accrued interest payable. April 1, year 2, now we've got to record interest from January 1 to April 1, 3 months worth of interest again. 900,000 times your market rate, 6%, market, times 3/12. Accrued interest payable, reverse, that 13,500, and we cut a check, 900,000 times your coupon rate, 6%, times 6/12, $27,000. Okay, so even though the bonds here were issued at par, if they weren't, market rate dictates the interest expense, as does the initial carrying value of the liability. Okay, face value dictates your coupon payment, interest expense, beginning carrying value of the liability, times the market rate, times the number of months, 3/12. okay, if the bonds were not issued at par. But you can use the same formula, whether the bonds are issued at par or not. Okay. Oh, sugar. That's all I got, damn it. Oh, man. That flew by. That flew by. Well, sincerely, folks, I want to thank you so much for your time and attention. I can't tell you how much it means to me to be a part of your journey. Really, it's a hell of a honor to be chosen. UWorld, myself, Megan, the entire team, we take this very, very seriously. Okay, I do my fair share of joking around, trying to keep it lively, but I'll tell you what, passing or not passing this exam will affect the trajectory of not only your professional life, but your personal life. Think about the money, think about the opportunity. This is not about our love of bonds or leases or pensions or anything else. If you've got a degree in accounting, you've got to pass the CPA exam. I don't care if you move on and do marketing, management, you become a school teacher. You will never regret. Those 3 letters forever will open more doors and opportunities for you. How could you go 4 or 5 years, get a degree in accounting and not be a CPA? That's like going to medical school and then never passing the boards to be a doctor. Like, what are you doing, right? You've got to do it. You can do it. Slow and steady, folks. We're not saying we believe. Look, FAR, bar, I know takes more time, but spread it out. You don't need to study 20 hours a week. Give me 10 hours a week. Give me 40 hours a month. Most people could bang this out in 4 months. And if you need a little bit more time, if FAR is the first section you're sitting for, the time, the clock, the 30 or 36 months, that doesn't begin to close until you pass your first part. So do FAR once, do it right. Make it manageable, spread it out over time. But you know what, man? Cumulative reviews are a must. When you put together your study plan, you can't study something with me in week 1 and not look at it for 4 months. Out of sight, out of mind. When you're a third of the way through the content, we're going to remind you that week in your study plan, you're going to do a cumulative review of what you did in the first third, 2/3 of the way through. You're now going to do a cumulative review of the first third and the second third. And then when you get to your final review and when you watch the cram course where we summarize and prioritize, man, you're going to be cranking. You need a few days to do that, and then you're ready to do those practice exams as Charlotte suggested. But the right way to do it is slow and steady. That's why even if you're sitting for, look, audit or ISC, I get it. There's no math involved. You know, Reg and TCP, I know the passing rates are really high in the 70s, pushing 80. But I'm telling you, you want to increase your probability of passing, spread it out. Even if audit's going to take you, you know, just let's say 80 to 100 hours. Don't try to squeeze that in, you know, 25 hours a week in a month, because then now you're cramming, now you're memorizing, you're not understanding. When you spread it out over a longer period of time, now you're really understanding it. When you go through those multiple choice, folks, put the pen to the paper. If you get something wrong, it's a great opportunity to learn. You get it wrong here, you won't get it wrong exam day, but write down the mistake you made. What you write, you will remember. If you got it right, please make sure you got it right for the right reason. And we're not the course that says, hey, you got to do every question in the software. Yeah, if you quit your job and had no family, no friends, you put your dog to sleep, you could work the tens of thousands of questions. But who the hell wants to do that? Our software is going to tell you, man, listen, this is a difficult topic. If you can just get 76% of the questions correct, and maybe you only have to work half of them, based upon prior students through our program, our software is going to tell you you're kicking ass. You may not realize it because you're studying by yourself, but you don't realize on difficult topics like pensions or leases, a 76% correct might put you in the top 10% of the candidates. That's what the software is going to tell you. You're proficient enough. And then when you do your cumulative reviews, the software is dynamic. We might tell you, hey, you know what? You know, a month ago you were proficient, but you lost some of that. Now we're going to feed you additional questions in that subtopic to keep up that proficiency. So you can and you will do it, baby. Slow and steady wins the race. If I pass this exam, Lord knows you guys should get a perfect score. All right. Again, if you're interested in UWorld, talk to Charlotte. You know, we'll give you a free trial. We want you to see the questions, the task-based simulations, because we want you to feel confident. Yeah, this is the right course for me. So we really appreciate your time and attention. Hopefully you got something out of this. We got more of these coming up. April 29th, we got leases. Then we got statement of cash flow. Let's go. Consolidations I already did in the past term. So we're moving on to leases, April 29th. Statement of cash flow, July 28th. Okay, you're going to rock those topics. So good luck studying, guys. Thank you so much. Megan, any questions I should answer content-wise before I say goodbye?
No, I told you I had all the answers. I took care of all the content stuff. I make this easy for you, Pete. Like, that's why you
Megan,
have me.
Let me tell you something. Megan is you want to talk about one of the nicest people you're going to meet, but one of the smartest people as well. She does a lot of our behind the scenes with the big 4 accounts and top 10 firms and all the stuff. Like, she's just remarkable because she really, not only does she know her stuff inside and out, but she can explain it in a way that you're likely to understand. So, Megan, thank you so much for that. And, yeah, it makes me obsolete. So I'll let you guys go. Thanks again, and I'll see you. You can and you will do it. We are on our way to a CPA, and who's better than us, Megan?
Nobody.
Let's go. See you guys later.
Nice. Thank you.